Hey everybody, welcome back to the channel. Today I'm going to go over the London Silver Bullet on July 27th. The dark gray area here is the 3 a.m. to 4 a.m. Eastern Standard Time. Now I want to show you that how you could have taken a loss here and then you could have taken a win, right? So as we trade, price changes our plans as each candle is painted. So when we come to the chart here, the first thing we see is buy side liquidity has been taken. Alright. We need this swing low to be taken out for a market structure shift because that's the swing low that took out the swing high or created the swing high. So when that gets broken here, we're market structure shift. Now we're looking for fair value gaps. There's one here. There's one here. Let's mark out this one. Let's also mark out this one. Mark that out as fair value gap right there. So what do we say? We want to see it come into the second one. Obviously it didn't. So you could have taken a short here when you came in here, all right? I know that a lot of people did. I just watched Twitter saying they took a loss and then they took a win. Well, here's what happened. They took this, but if you would have pulled a fib on this, because look at your total range here, first of all. From this point right here, okay, come on. From here to here, you're talking 3 points, 3¼ points, right? Not a huge range. So when you come from here with the fib, 50% here, you need it to come into this to go short, right? That's a premium. This is in discount. I know that when you go to the next trade, everyone's gonna be like, well, "Wait a minute, you don't use the fib for that one." I'll explain why, because there's logic on following price action. So on this, all you have is fair value gaps. That's fine. There's no volume imbalances. There's no liquidity voids in your favor, telling you that price is actively trying to reach somewhere quickly. Okay, so that's why the fib here worked out well. Now, however, if you took a trade there, you would have put your stop above this. It's 2 handles, so you're risking, $100. And you go for your 5 handles down here, which would have been, the low over here would have been your draw. So price came up and you took a loss, right? But here's how, if let's say you got into this trade, how you could have managed it and lowered your risk. You still would have taken a loss, by the way, but how you could have minimized it a little bit further, right? Well, when you see that sell side's been taken right here, that's one thing. You're like, okay, that's good. Sell side's being taken, that's fine. But how does it react? It immediately takes it out and then it shoots right back up. Okay? That's fine. But if you notice, you have a fair value gap right here. Okay? So when it violates that, that's 1. Okay? Then you have another fair value gap right here. Okay? Let's just mark this out, fair value gap. Okay? But you also leave behind a liquidity void right there, okay? And this candle probably took you out here because it came all the way up there. But as soon as price was trade past this fair value gap, traded into this fair value gap, beyond this fair value gap right here, this one, you should have been getting out right here. As soon as this one opened with a liquidity void, you're out. You're reducing your risk. You've got 3 PDRAs already violated. There's 1. There's 2. This starts the third, and it started the third above this fair value gap right here. So there's your 3. Get out of the trade. And if you got out of the trade right here, let's just say you're right here, you saved yourself 3 ticks. Okay? So that's how you could have avoided the loss. Okay? So just putting that out there, a lot of people will do this. Now, had you used the fib, you wouldn't have been in the trade in the first place because it never came up here. If you would have traded up here and moved your stop right here after there, you would have gotten out. Gosh, if you would have followed the same logic, you'd have got out with, for $25 of a stop if you managed the trade that way. So either way, that's how you could have avoided taking a bigger loss there, managing your trade. Microstructure on what's going on with the candles. Very important as you take a trade. Okay, so we got out there. Now, comes over here. This is the swing high that created the swing low over here. Technically, you could use this one, but let's just use this bigger one right here. Market structure shift when it closed above that, right? Now, I'm gonna take the short position off just so it's out of the way. When I see a liquidity void, especially, but when I see a liquidity void and or a volume imbalance, I'm looking at those like, okay, price wants to go somewhere quickly. All right. So when it takes this out, I'm looking left. And when I see this, I know this is just a wick. That's still a candle. That's a breaker block. If you look at it, this is a low. There's the high. There's a lower low. When price came through it and comes back, that's a breaker block. So that breaker right there. You also have an order block right here, this down close candle. Price comes up, comes back down, stops at the top of the breaker and order block, just comes in institutional order flow entry drill right there. You're getting in right there. You're taking your long. Your stop is below, in the middle of this fair value gap, underneath this liquidity void, part of this big fair value gap, underneath the breaker block and the order block. It's a very safe stop. Okay, you've got so many PD arrays that are going to hold price there. You have plenty of chances to mitigate your loss or reduce your stop if you needed to, if it was just going to hover around here. But as soon as it stopped, you had a bullish volume imbalance. Why do I say that? Let me take off this long so it gets out of the way. Price stopped right here, okay? Price started right here on the next candle. That right there is a bullish volume imbalance, okay? Price went up, came up. I'm going to put this position back on. And there's your 5 handles, right? Now, there is a draw on liquidity. This is a daily target. The next target was like way up here on like 30 range, the daily target. There's an hourly one up here. I don't have it marked. So when you got out there, there's your silver bullet for London. Okay, so we could have avoided the loss had we used our fib. If we did get in the trade anyway, we could have mitigated our not taking full stop out if we would have looked at price action and seen that volume imbalances, liquidity voids, fair value gaps aren't being respected and they come through. Once ICT says once you violate 3 PD arrays, you're next. So when 2 are violated, I'm moving my stop, lowering my stop. If the third one is, I just cut it, kill the trade then. So this is how you could have mitigated that, and then here's how you could have taken this trade, and you could have gone up. It went up quite a bit actually, so if you would have moved all the way up to 10, you could have taken 10 right there, I believe. Yeah, it would have hit you right out there. So there's your London Silver Bullet for July 27th.